As of 10 a.m. Eastern Time today, April 13th, 2026, the United States military has begun a naval blockade of all maritime traffic entering and exiting Iranian ports in the Strait of Hormuz. Brent crude has risen 7% this morning to $102 per barrel. WTI is at $104. That is a gain of 40% since the war began on February 28th. The Dow has dropped 500 points in futures trading. The S&P 500 is down 1% before the market opens. Two countries are watching this number at the same moment. One produces oil in the Gulf. The other imports 80% of its energy through a strait that is now under simultaneous Iranian toll control and U.S. naval blockade, operated by opposing powers simultaneously through the same 34-kilometer passage. Same choke point, two different toll booths. On zero functioning commercial traffic. HI viewers. Do you think the U.S. naval blockade of the Strait of Hormuz makes the energy crisis better or worse? Tell me below. Iran has been charging up to $2 million per ship in tolls for passage through the strait. A gallon of gasoline in the United States cost $4.12 on average this past Sunday, up 38% from the start of the war. Iran's parliamentary speaker has warned that the blockade will soon make Americans nostalgic for $4 to $5 gas. Most people think this is a military standoff between the U.S. and Iran. The data says it is something older. It is the 1973 oil embargo. But this time, the choke point is physical, the debt is larger, and there is no political switch to flip. You think this escalation will be resolved in days. The Strait of Hormuz has been effectively closed for 43 days. The window that analysts warned about is already here. Most people believe supply disruptions are temporary. The assumption is that markets absorb shocks and prices normalize once the geopolitical event passes. The reality is that the Strait of Hormuz was never just a shipping lane. It was a single point of failure embedded at the center of the global energy system, and the world chose to depend on it for 50 years without building a real alternative. The Strait of Hormuz, through which approximately 20% of global oil trade and 20% of global LNG supply flows, has been effectively closed to commercial shipping since late February. Roughly 20 million barrels of oil alongside 10.8 billion cubic feet of LNG per day ordinarily transit the strait. The IEA estimates that even with full utilization of available pipeline bypasses, approximately 16 million barrels per day of oil flows remain at risk from a full closure. This changes the balance. Goldman Sachs warned this week that Brent crude prices are set to average above $100 per barrel this year if the strait remains mostly shut for another month. Average Brent prices above $90 per barrel in 2026 would slow global economic growth and push the US and EU into recession. If Brent averages $100 per barrel in 2026, global economic growth would slow to 1.7%, down from the pre-war forecast of 2.5%. In the case of $200 oil, a global recession is inevitable, with the global economy likely to contract by 0.5%. You face a decision at this point. Option A. Absorb the cost through strategic reserves and wait for diplomatic resolution, accepting that the price of that waiting is measured in inflation absorbed by every household in every importing economy. Option B. Use military force to reopen the strait, accepting that any miscalculation involving Chinese vessels or Allied ships paying Iranian tolls triggers an escalation that makes the energy shock the smallest problem on the board. Capital Economics chief economist Neil Shearing warned, would the U.S. Navy seize Allied ships that have paid tolls to Tehran? Would it target Chinese vessels in the strait? Either outcome would represent a significant escalation. You think the blockade gives the U.S. leverage? It may also give Iran a reason to close the strait permanently, rather than selectively. In 1973, Arab oil exporting nations cut exports to countries supporting Israel. Oil prices quadrupled within months. Inflation in the United States exceeded 12%, according to the U.S. Federal Reserve 2004. Unemployment and inflation rose simultaneously. The tools for fighting one made the other worse. Economists named it stagflation. The decision to cut supply made sense in the moment. The consequences lasted a decade. In conversations with more than 36 oil and gas traders, executives, brokers, shippers, and advisors, One message was repeated over and over. The world still has not grasped the severity of the situation. Many drew parallels with the 1970s oil shock, warning a prolonged closure of the Strait of Hormuz would threaten an even bigger crisis. The scale of supply removed from the market is at least as big as during the Arab Oil Embargo, when surging energy costs led to sharply slowing growth and stagflation. This is where power moves. The difference in 2026 is structural. The 1973 embargo was a political decision that could be reversed by a political decision. The 2026 Hormuz closure involves Iranian mines, IRGC vessel controls, U.S. naval forces, a ceasefire that collapsed within hours of being announced, and now a full blockade declared this morning. Maritime intelligence firm Windward noted, transit through the Strait of Hormuz remains restricted, coordinated, and selectively enforced. There has been no return to open commercial navigation. BCA Research's Marco Papik estimates that for now the world has lost 4.5 to 5 million barrels per day of oil due to the war, amounting to about 5% of global supply. But that number will double by mid-April, becoming the largest loss of crude supply in history. Mid-April is now. The doubling has arrived. You think the 1973 parallel is instructive? The 2026 version has a longer supply chain, a more indebted global economy, and two navies in the same choke point. Today's economy entered this shock in worse condition than 1973. Headline inflation in the United States is currently tracking toward 4.0%, effectively silencing any talk of interest rate cuts from the Federal Reserve until at least mid-2027. The Federal Reserve is trapped in a policy corner, unable to cut rates to support growth for fear of further embedding inflation expectations, and then it stops. No warning. The Federal Reserve entered this period of conflict already contending with inflation above the 2% target and nascent softening in the labor market. Having paused its easing cycle, the Federal Open Market Committee would find any resumption of rate cuts significantly complicated by an oil-driven inflationary impulse. Elevated rates against a backdrop of labor market weakness and a financially stretched consumer raise the specter of stagflation. Nothing changes, except everything. You have two options when supply-driven inflation meets high debt. Option A, raise rates to kill inflation, accept the recession, absorb the political cost in a U.S. midterm election year. Option B, hold rates to protect growth, accept inflation persistence, accept the currency pressure on every importing economy. The Federal Reserve cannot address the source of the inflation. It can only decide who pays the cost of it. The broader significance of this oil spike cannot be overstated. It has effectively reset the higher-for-longer interest rate narrative. With the Consumer Price Index stubbornly stuck near 4%, the Federal Reserve's previous roadmap for 2026 has been discarded. The energy tax is acting as a natural brake on economic growth, but because it is supply-driven rather than demand-driven, the Fed is trapped. The difference between 1973 and 2026 is not the energy shock. It is that in 1973, the debt structure had not yet been built. According to the Institute of International Finance, 2023, global debt exceeded $300 trillion before this war began. The same shock lands on a system carrying 30 times the leverage. You think the central bank has better tools now. The debt that constrains those tools is the largest in recorded economic history. Energy is not fuel, it is leverage. The geographic distribution of Strait of Hormuz flows illustrates acute vulnerability. Asia accounted for approximately 84% of the crude oil and condensate shipped through the strait in 2024. China, India, Japan, and South Korea collectively represented 69% of total flows. Japan imports approximately 95% of its crude from the Middle East. South Korea sources roughly 70% of its oil and a significant proportion of its LNG from the region. The difference is not small. As of early March, the Nikkei 225 had fallen approximately 8% since the onset of the conflict, while South Korea's KOSPI declined over 11% over the same period, with a circuit breaker triggered on March 4th. These are not speculative moves. They are recalibrations of structural exposure. You face a decision at this level. Option A. Treat the Strait of Hormuz crisis as a temporary geopolitical premium, and wait for normalization, borrowing to cover the fiscal cost of elevated energy prices while reserves hold. Option B, treat energy access as a sovereign security question and begin immediate structural diversification, accepting short-term transition costs that are painful but bounded, rather than long-term dependency costs that are compounding and open-ended. For Japan and South Korea, the window in which current reserve buffers remain adequate is narrowing, and beyond it lies a supply shock with few historical parallels and limited policy tools to offset it. Power follows supply. This has always been true. What is new is the speed of the transfer, and the fact that the U.S. naval blockade announced this morning has now extended that uncertainty into an indefinite timeline. You think energy security is a long-term policy question. As of 10 a.m. today, it is a live operational one. Oil rises. Everything attached to oil rises with it. The rest of the world has been affected by panic buying and severe disruption to the distribution of petroleum, diesel, LNG, and urea for fertilizer. Much of the world's supply of these is sourced from the Middle East and transits the Strait of Hormuz. Fuel costs up, shipping costs up. Fertilizer prices up, food prices up, inflation sustained, central banks constrained. The Persian Gulf accounts for roughly 30 to 35% of global urea exports and around 20 to 30% of global ammonia exports. Qatar Energy declared force majeure on its LNG contracts on March 3rd. Restarting liquefaction capacity takes weeks. The food price shock is not a delayed consequence. It is already embedded in next season's harvest costs. In the Gulf region, where most food is imported, physical supply chain disruptions caused CPI food spikes of 40 to 120% by mid-March 2026. Gas prices in the United States have risen $1.16 per gallon since the start of the war. Jet fuel in North America has spiked 95% since the war began, causing multiple airlines to raise prices for checked baggage. Shipping services including the U.S. Postal Service, Amazon, and FedEx have implemented fuel surcharges. If the strait stays closed, the world will have to significantly reduce its oil and gas consumption, but not before prices spike to a level that forces consumers and businesses to fly, drive, and spend much less. Already, demand has begun to drop, and some countries in Asia are hoarding and rationing fuel. You think consumer prices will stabilize once the ceasefire holds. This morning's blockade declaration is not a ceasefire. It is an escalation. The countries on the correct side of this structure are repositioning, and the repositioning is accelerating. Gulf sovereign wealth funds have invested tens of billions of dollars in AI. Saudi PIF has a partnership with NVIDIA and AMD. Abu Dhabi's Mubadala joined with BlackRock and Microsoft to create a $30 billion fund. These Gulf nations are no longer able to export oil and gas or import food. After the U.S. and Israel attacked Iran, Tehran has blocked the strait. The great liquidation threatens to trigger a fall in stock markets, burst the AI bubble, and destabilize U.S. treasuries. The system is not stabilizing. It is adjusting. The 2026 Iran war has caused a systemic collapse of the Gulf Cooperation Council economic model. The European Central Bank has warned that a prolonged conflict will likely trigger a period of stagflation and push major energy-dependent economies, including Germany and Italy, into technical recession by the end of 2026. The OECD expects the United Kingdom to be the worst-hit major economy globally. Chemical and steel manufacturers in the United Kingdom and EU have imposed surcharges of up to 30% to offset surging electricity and feedstock costs, potentially leading to permanent deindustrialization in some sectors. Brent crude has gained 40% since the start of the war. WTI is more than 50% higher than it was before the war effectively shuttered the strait. The U.S. blockade announced this morning adds a new variable. It does not remove the old ones. You think the geopolitical consequence of this war ends when the shooting stops. The financial architecture it is reshaping will outlast the ceasefire by years, if a ceasefire arrives at all. Most people believe stagflation is a historical anomaly. The 2026 Strait of Hormuz crisis has ended that belief. The conflict has echoed the 1970s energy crisis through acute supply shortages, currency volatility, inflation, and heightened risks of stagflation and recession. This is a textbook left shift of the aggregate supply curve. Higher prices, lower purchasing power, and weaker demand. A dangerous stagflationary cocktail. Stagflation is not triggered, it is built through supply constraint meeting, elevated debt meeting monetary policy that cannot address the underlying mechanism. All three conditions are confirmed in the data as of April 13th, 2026. To quote Stefan Angrick, Japan economist at Moody's Analytics, there is no Goldilocks scenario where the conflict ends and everything just snaps back to the way it was. And today, the strait is not just closed. It is blockaded from both sides. Your grandfather lived through conflicts shaped by systems he never saw. Your father absorbed the economic consequences of those decisions and called it stability. The structure was already in place before you were old enough to question it. Global power does not depend on conflict alone. It depends on the economic systems that make conflict profitable, the choke points, the debt structures, the currency arrangements, and the supply dependencies that determine which economies absorb the cost of instability and which economies collect it. This is the economic records. We exist to examine these systems before they finish their work, to identify the patterns that determine financial outcomes long before those outcomes arrive. The ledger always balances. It has balanced in the same direction for 3 generations. This channel exists to make sure it does not balance that way for a 4th.